to Around the Horn in Wholesale Distribution with Kevin Brown and Tom Burton. Sponsored each week by LeadSmart Technologies, Tom, Kevin, and their guests review the news of the week and dive deep into the topics impacting manufacturers, wholesale distribution, independent sales agents, and the global wholesale supply chain. Whether it's M&A, SaaS and cloud computing, B2B e-commerce, or supply chain issues, we peel back the onion with our guests into the topics that impact your business the most.
Good morning, good morning, good morning, good morning.
Good morning.
What's happening?
Good afternoon to Mark.
I was just going to say, it's lunchtime for Mark, right?
Yeah. It is, yes. 2 minutes into lunchtime.
Yeah, well, and it just makes me think, I think the first time you were with us on the show, you were here in the U.S., but we got to know you as a listener originally when you were still in the U.K. So we always used to joke about that you're sitting back and listening to the show with a gin and tonic. That sounded very British.
And, yes, absolutely. Yes, it's unfortunately I can't do that anymore.
Have a gin and tonic for lunch today, maybe.
That's right. You could have that's right. It's 5:00 somewhere.
That's right.
Very good. Well, welcome everybody. I'm Kevin Brown. I'm here with my lifelong friend and business partner and co-host of our show, Tom Burton. And then we've got our good friend and guest today, Mark Gilham from Enable. Mark is, I think we met for the first time, didn't we, Mark, at an Industrial Supply Association event? Is that right?
Yes.
Yeah. Since then, we've had some lunches and a great dinner in Las Vegas late last year. That was memorable for me. We had a nice evening chatting with our good friend Pierre from Oblico and a bunch of other industry and technology people. And we snuck off for a nice dinner in Vegas. And all Tom's thinking about is the seafood towers and wine lists.
Right? I get to see another expense report.
Anyways, that was a fun night. Appreciate that. Enjoyed. But it's great to have you back with us, Mark. Before we kind of dive into the regular part of our show today, why don't you just tell us maybe a little bit about Enable and what you guys do there, but just as importantly, tell us about Mark.
Yeah, sure. So hopefully Mark and Enable, they kind of come as a package because I was a client of Enable's before working for them. My background is accounting. Spent a lot of years in the distribution space. Hits the elevated heights of being a CFO, and moved over to software shortly thereafter, where I spend most of my time with Enable now, really focusing in on how businesses do trade together. So more in the B2B space, how are manufacturers and the distributors really trading together and trying to streamline and bring clarity to those operations. So really interesting space, especially at the moment, because I think businesses have squeezed most things in their kind of their profit and loss account, but we operate often in the little gaps, and we're still seeing some big opportunities there. So, and AI is obviously challenging us as it is everybody else. So it's an exciting time.
Good. You just shared some things earlier. We'll build into the show later about some discussions you've been having related to that. Those small spaces add up pretty quick. I think I heard years and years ago that you find enough grains of sand, you'll have a sandcastle. And right, so you do that, and we do quite a bit of that with what we do at LeadSmart as well. So you're originally from the UK, now living in North Carolina, right?
Correct. Yeah. So
right.
The summer is starting to come here. So yeah, this is when
I was starting to pick up that southern accent. So yeah, I was wondering where that was.
I will say y'all a couple of times.
Very good. So you've
question for Mark, Kevin, before we move on.
Sure.
I think you said something that I think is very important. We talk a lot about manufacturers and we talk about distributors, right? But what I heard you say is you spend a lot of time really understanding the interrelationship between those two and how, money and process and everything moves between those two kind of critical entities in the process. Did I get that right?
Yeah, absolutely. So this can be whether it's the pricing or the rebate side of things, and Enable helping both of them. But it's really interesting seeing what happens when you take a manufacturer's sales team, a distributor's procurement team, who can do a deal, but does that deal actually drive something in the marketplace or not? Does it make it to the distributor's sales team, which obviously is a big part of your world? Mm-hmm. And how do you connect those dots? And technology all of the time is getting better, but I still think there's a huge opportunity there.
Yeah, I agree. I think the connecting of the dots, as you said, has been historically difficult, right? Because of data integrations, all of that. But I think AI starts to open up the door to make that dot connecting easier and more scalable and more reliable and sustainable.
Yeah, absolutely. And then that data and that insight, starts to get fed into kind of platforms like yours at LeadSmart.
Yeah.
So all of a sudden, you have the full picture. Everybody has the full picture. And I talk a lot about businesses trading intelligently. We're going to move from trading on instinct to moving to trading on insight and intelligence. Is where I'm trying to get businesses to.
That's great. So Mark, the core main functionality of how most people that know Enable would probably look at that as rebate management and some related tools to that, but it goes a lot deeper than that, right?
It does, and it's evolving all of the time. We started many years ago when I was a client, managing rebates for distributors, making sure they were collecting everything from their suppliers. And it's evolved since then to working with both the manufacturers now and the distributors. But then more recently, we purchased a piece of pricing software, which again is price management. So it's really about making sure that your well thought through commercial plans are executed properly. The customer is charged the right price, because I know from my distribution background, you make one mistake on a customer's statement, they go through the whole statement and it erodes trust. So we really focus in on that area, just making sure execution is perfect.
That's great. Very good. Well, that kind of ties into who Tom and I work for, which is LeadSmart Technologies. And LeadSmart is the sponsor of our show here and Around the Horn in wholesale distribution and manufacturing. And LeadSmart is what we have developed at our company is a enterprise growth platform. Our enterprise growth platform builds on the type of things that Mark's talking about with Enable, where we've got lots of siloed data typically around a business. We've got, or you might want to use the term fragmented data. So we like to look at all that data that comes in across the business, whether it's that pricing data, it's rebate data, it's marketing automation data, e-commerce data. Of course, ERP data is critical. And we bring all of that together into a data hub in our platform. And then we use that intelligently with sales enablement tools, what we call smart CRM as well. And we bring all of that data that's typically fragmented into one place. Then we can use artificial intelligence against that and other advanced business tools and technology, where we can use those against that combined data that's in that platform to make intelligent business decisions across the business. So, historically, people have looked at our company as a company that does CRM, but CRM is now a component of what we do, but we're really, as we described, this enterprise growth platform. So a lot of exciting news about that coming out as well. So if your company is looking to digitally transform, you recognize that you've got fragmented data, the AI bell is ringing, whether it's from leadership or a board or just what you're seeing online and reading and social and so forth. And it's time to really try to bring AI and the future of business into your organization. We would love to chat with you and help you see how you can take that fragmented business and start uncovering both opportunities and risks that you've never seen before in your business to accelerate growth as you go. So, Tom, we get together every week, don't we? We talk about the news of the week. We've got a wonderful newsletter that goes out. That newsletter goes out to well over 10,000 people, I think 12, 13,000 people roughly now. And it's called Around the Horn in Wholesale Distribution. So if you're listening in with us live this morning on YouTube Live, LinkedIn Live, or Facebook Live, you're seeing three handsome faces and a newsletter and some charts and some graphs and things like that up in front of you today. But if you're listening on the recorded podcast on Apple or Spotify or Amazon or Odyssey or wherever that might be, you will not be seeing this screen, but we would love to get that newsletter out to you. Again, it goes out to thousands of people in dozens of countries right now. You can reach out to us three simple ways. If you're active on LinkedIn, you could just search Around the Horn and Wholesale Distribution on LinkedIn, and you'll see the page there. If you went to the LeadSmart Technologies page on LinkedIn, you would see in the far left column a little button that says newsletter. You can click that and sign up there, and that'll come directly to your email, but you'll click on it to read it in LinkedIn. If you would like it sent to your email box, simplest way to do that is to just send an email to hello@leadsmarttech.com. We'll get that out to you right away. And then finally, we have a website for the podcast. It's www.aroundthehornpod.com. And you can sign up there, see past episodes and so forth as well. And then on the LeadSmart Technology website, it's leadsmarttech.com. You can click on the resources segment, and all of our past episodes are there as well. So we get together every week. Today is week number 192. Amazing to me that we've been doing this 192 times, but we continue to get together every week. And so we're coming up on 200 here shortly. We're going to have a big extravaganza for that. But we hope that you can continue to join us. The one thing we would ask you is if you like what you hear each week, to chime in, give us some thoughts and ideas in the comment section if you're live with us. But if you're listening in Apple or Spotify, wherever that might be, click the subscribe button, and then big help to us if you leave a review to go with that. We get this show out in front of more people. So from that standpoint, let's dive into the news. We talk each week about, we start off in the newsletter about the economy and supply chain. So this week, core inflation hit the annual rate of 3.3 that we can see in April with those numbers adjusted, and the Fed's preferred gauges are doing some wobbling up and down. Tom, you want to take us away and get started on that?
I actually wanted to kind of do a 2-for-1 here on these first two articles here because they're related. And I learned something that I didn't know about the economy. And Kevin is an expert economist like you are. You probably knew a lot about all this already. But what they're talking about in these first two articles is core inflation versus trimmed averages. So do you know what trimmed averages are?
I'm going to have you explain it to me because you're a computer scientist and I just studied business.
Okay. So core inflation, right, that we hear a lot about is taking inflation but removing the cost and increase of food and energy, right? So you get rid of food and energy, and then you end up the cost of everything else, whether it's insurance or services or whatever the case may be. The trimmed average looks at things each month. So rather than saying we're just going to remove food and energy, it looks at the outliers each month. So let's say for this month that health insurance was crazy went up and something else was static or went down or whatever. It will trim both ends of the bell curve, if you will, right, and then look at the inflation based on the middle, but based around month to month versus just arbitrarily saying, let's remove food and energy as the core piece there. Let's go. So what I find interesting about this is that is Marsh's favorite way of evaluating inflation. So
you're going way down a new path now. So now you're talking about the new Fed chair, Kevin Marsh, right?
Marsh. Yes, but I was going back to my point is the differences are quite significant, right? The difference is if you look, and I'll bring this back up again, if you look in the first article, core inflation was 3.3%. But when you did the trimmed average, it was actually 2.3%. Right. So that's significantly different, especially if that is your gauge for how you're measuring the economy, rate cuts, and everything else.
Well, it's kind of how they score, like a lot of sports too, right? I think it's like gymnastics and some things like that, right? They throw out the top and the bottom, and they come to a mean, and look to it from that point as well. I would suggest that you're just reinforcing the idea that one of our guests, a regular on this show, has been saying for probably 2 years now that there's a better way to figure out what the right percentage point is and how we get there, right? Because if you're talking about now as like we've got trimmed averages or these core components of it, and then they're measuring that against this broader number where you have food and energy and other things tied into that, maybe it's time to take a big look at really what is it that we should be tracking.
Yeah, and I think, by the way, good morning to Bob. And I wanted to touch on Christine's comment here, which makes sense. Look, it's easy to pick a number, right? Or pick a way to calculate a number and determine what makes the story sound the best.
Yep.
But I do think arbitrarily just removing food and energy, right, in there, or you look at the impact, kind of the weight of what energy could be on those things here is I do agree that this is maybe a more intelligent way of looking at things because things change so rapidly. Mark, do you have any thoughts on this?
Yeah, I mean, I'm going to put my accountant's hat on here. And the way I see it is we require consistency in a set of standards to the point I think you're making, because you can make numbers always tell a story and the story you want to tell. The problem you've got is if it's not comparable to past stories that have been told, you don't really know the kind of the true performance. So for me, it is picking. I think the challenge is there's no perfect system. So and because we've been in a very extraordinary environment over the last probably decade nearly now, you start to see some kind of inconsistencies in what the data might tell you. To your point about using this newer framework, it feels like it cuts out some of that, or it kind of normalizes things to a degree. But then that might mean that we need a different mindset in terms of we might have previously thought 2% is the right number, but if 2% was always based on an old calculation, do we now need to say actually 1% is the right number?
Gosh, you're smart.
Well, Kevin's the one who wants to go the other direction. Kevin wants to change it to 3 or 4%.
My bigger point is I don't forget about what the number is how do we get there? I mean, I just was bringing up some info here that, I've Mark, you've probably heard me harp on this before, but, if we look back to this, and I just pulled this up, right? It says between 1989 and 1991, New Zealand pioneered the formal inflation target, initially setting it at 0 to 2%. Canada and the UK followed suit by adopting explicit 2% targets, right? And this all started because a politician in a hallway in New Zealand, right, where there's more, all my Kiwi friends, I'm sorry, but there's more sheep than people. And I don't know how New Zealand sets the gold standard for the world, which we do. I mean, they did it, right? So good on them, right? That they were able to do it. But they did that. UK and Canada jumped right in. Then from 98 to 2003, the European Central Bank said price stability is inflation under 2%, and later fine-tuned that to below, but close to 2%. And then in January of 2012, the U.S. Federal Reserve officially announced a public target of 2%. And in 2013, the Bank of Japan followed suit. So it's like, it feels like, and again, I studied business management in school, and Tom's a computer scientist, and Mark, you're an accountant. In the UK, do you say chartered accountant? I know that's what they say, like in New Zealand and Australia, I think. Is that?
Yeah, there's different qualifications, but generally, yes, most accountants are chartered.
So, but anyways, this looks and feels like people just said, yeah, it's a good number. Let's go with that, right? And here we are. But as we talk about all the time on this show, right, we have instant access to data, and all that the Fed in the U.S. now is looking at is lagging data on all of this. And I'm just suggesting maybe we're in a world right now where putting a committee together, maybe of European Central Bank and the U.S. Fed and a few other organizations like that, and saying, let's look at all the data that we have and what's real. If you're at a place to, Tom, and I'm glad you brought that up, in talking about that, trimmed average, so to speak, of that as well, and core versus non. If we have to put all those variances in place with that, maybe there's a better way that we just use as a standardized system. And whether that number is 1%, 2%, or 3%, I don't know. I'm not smart enough to know that. It just seems to me like we live in a day and an age that we could get better access to real-time data that truly tells us versus, and Tom and I laugh about this all the time, is because we talk about it on the show regularly, is it just seems forever we're looking at updated or restated data, 2 months later. Well, what really happened in April, and here we are, this first article, right, that we were talking about today in the newsletter, is talking about April's inflation rate of annual rate is 3.3, and we're Sunday's June, right? We've got access to better data. Is my point.
Yeah, I mean, to pick up. So Christine's put a couple of great comments, and I know Christine, and she's super smart, very much a data analytics type.
So we should have had her on the show.
Should have, yes. She'll be answering these questions far better than me. But the way I see it is, you can't be selective with this kind of thing. You can't turn around and say, well, actually, because the price of gas has gone up, we'll exclude that. That and things like that. We just need consistency and benchmarks to work against. And then the other thing I would say, in the most surprising of places, I went to get my hair cut, if you haven't noticed.
Yeah, it's very handsome.
Thank you. And the barber, I asked him, because I think, my view is, who better to ask than your barber about what's going on? What are people generally in the local community feeling? And he said everybody's feeling the squeeze. And he said it wouldn't surprise him if the government doesn't do something to buy goodwill, like giving everybody a bit of cash. He said, but then that's just going to push up inflation, and we don't want that.
Or flooding money into the economy, right?
So I had an economics lesson from my barber, but it was really interesting, to hear, just the general consensus, which is generally people are feeling the squeeze, but they're not seeing it in these numbers that are getting reported. So they're a bit confused.
Yep. So what you're saying is that your barber listens to the Around the Horn and Wholesale Distribution show each week and really comes out of that with some great insights.
That's absolutely it. Yes.
Yeah. Perfect. That's right. As my father-in-law used to say, you lie to your friends and I'll lie to mine, but let's not lie to each other. So, anyways, I think there's some opportunity for better data, I guess, is my takeaway from all of this. But I'm glad, Tom, you brought that up about that the core component as well. So,
and we can move on from here. But what I hear when reading these is that maybe he's looking at, and I'm not saying that the trimmed average is the right way or the wrong way. Mm-hmm. I think what he's trying to do is introduce some potentially different ways of looking at the data, mm-hmm. looking at it from multi-dimensions rather than maybe a more linear set of things that are there. And it'll be interesting to see then how that manifests in the mindset of the governors and how they move about with the rate cuts and so forth.
Yep.
That's the first time, and we've been talking about this for literally years, mm-hmm. and this is the first time I've heard this word trimmed average.
Yep.
Right. So
back to, you've got our newsletter up there again, but the first article we had was from CNBC, and it was talking about the updates to the April inflation numbers. Then the next two articles we had were related to Kevin Marsh, or Warsh, I should say, and as the new Fed chair. And the Yahoo Finance article there talked about him taking more of a Greenspan-style approach at the central bank. So, which was greatly supported by Treasury Secretary Bessent in that. So the idea behind that was basically he was looking to prioritize monetary flexibility. And, in fact, he even talked about suggesting that technology booms and specifically the adoption of AI will drive productivity gains and naturally lower inflation. So to me, this was encouraging. Going back to what we've been talking about is let's start looking at some things in maybe a different lens. And it just feels like, I can't remember, they use the term hawk and dovish, right, in all of this. And in Wall Street, we think bulls and bears, but it just seems like I've probably beaten up pretty hard over the last couple of years about the former Treasury Secretary. Former Fed Chair of Powell. But he just seemed to be way too cautious. I would listen to him talk, and I don't know about you guys, or Mark, if you've listened to much of the comments he would make after the Fed meetings, and it just seemed like he was so unbelievably cautious and every word parsed. And I recognize that one misstatement by a Fed chair can change markets and crazy things can happen from that. But it just seemed over the top to me. And for me, I like what I'm hearing from this particular article and what Warsh is saying so far is like, hey, we're going to look at some bigger picture stuff here. And he's tying that into Greenspan in that as well. So I think it's positive component there.
Yeah. I'm sorry, go ahead, Tom.
No, I was just going to say, I mean, Greenspan had a reputation, right, of holding off on rate increases, and certainly being not jumping in and raising rates. And even in the .com boom, he was, hey, let's let this play out. There's a lot of productivity, right? Why do we need to raise rates in an era of productivity increases? It wasn't that there was necessarily increased money flow into the system as inflation. So anyway, go ahead, Mark. I was looking at this from a planning perspective, and I agree that basically rather than making commitments, the view is, let's let some of these things play out, really be more agile in kind of policy. The only downside to that is, how do you plan around that? You can't create a 5-year model with one interest rate. So how do you plan things like your CapEx investments, debt refinancing, these kind of things as an organization? Business is going to have to go back to planning under things like rate uncertainty, because the Fed's not going to give a long outlook that that they can depend on. So I just think, yes, businesses are now going to have to start modeling in interest rate uncertainty into decisions. But it even comes right back to the inflation point. We as a distributor, I suspect many of the same, are the way our system works. We would buy at cost, we would sell, let's say, 2 months later at whatever that cost is. So actually, inflation was good for our margins, providing the market's paying for it. So when we're building out our profit forecasts or our working capital models, cash flows, how much inventory we're going to hold, knowing or having confidence around interest rates is really useful. So that's
sure.
This is obviously the offset of that. But I think it's better if you don't know what the future is going to be, or don't put things out there. So yeah, I agree. It's just going to need a different approach, I think, from some finance leaders.
When in doubt, right? When in doubt, use the prediction markets. So,
yeah, there we go.
I mean, and it sounds dumb and foolish, but at the same time, right? They're probably the most accurate sort of prediction of the future, to your point, Mark, to incorporate into planning, right? Of what you're doing. The prediction markets are going to generally be much better than you're going to hear out of CNBC or some media coverage or even maybe from the Fed themselves on some of the data or lack of data they provide. So it's interesting too, because a lot of these
Tom, tell us what you're looking at and describe it, because most people are not watching your screen.
Sure. So I've got Polymarket up here, the Fed decision, basically voting in June, July, and September. They have 3 months out. Clearly we've talked about this, right? 98% say there'll be no change in June. I believe it's around 93 in July, and 74 in September. So again, per the prediction markets, there will be a much higher, not a great chance, but a higher chance of a decrease in September than there would be. But if I was a business person, Mark, as you're pointing out, I certainly wouldn't be betting the farm on a 25% decrease in these things that are here. One of the things that I think is we're going to see more of in Polymarket and these other prediction markets is their API capabilities, to be able to tie into their APIs, use that into your systems to potentially help influence some of your predictability things that you're doing here. Because I mean, there's a lot of data here, right? There's a lot of data behind some of this. And it's not just these raw numbers, but if you through an API could get some of the raw data that is actually driving these things incorporated into AI, you would in fact be able to have potentially a reasonable way of at least a midterm set of predictability on things.
So I'll throw out to you, I think Mark, I think you're wise with that, your comment about the idea of, you want a benchmark that you'd like to be able to look to for predictability, right? But we haven't seen predictability related to interest rates in a few years. And I think if I'm looking at this, right, and it's kind of interesting, I look at this from, in my personal life, is there's a new roof getting ready to go on this house and a handful of other things. I'm working from my home office this morning, and a handful of things getting ready to be done to this house. And guess what? I'm not writing a check from it. There's going to be some of it's going to be financed. And my caution is rates going up, right? And because there's nothing that what we've talked about here or what Kevin Warsh is suggesting or what we're really seeing that would suggest an increase based upon especially how he believes the Fed is going to look. And by the way, remember, we had the very final vote of the prior Fed was going against what Powell and that group was saying. So there was already a little bit of an upheaval there. For me, if I'm a distributor or manufacturer and I'm thinking, or just a business person in general, I'm thinking about what the future holds, is I'd probably be looking at two components. One is there risk of interest rates going up? And then thinking about, okay, I would look at this and say, I've got a president who has 2.5 more years, right, in office, who has very clearly said his goal is fair, close the borders, stop fentanyl, fair trade, and with the tariffs and so forth, drive interest rates down, onshore, increase manufacturing, increase in jobs. That's where he's at. Warsh is there because the president realized two things I would suggest. One is Warsh is the guy that he could get across the finish line to get approved for the Fed that is most likely to push that agenda forward. Everybody agree with that?
Seems reasonable.
Yeah. So we've got somebody at the Fed now who has the president's support. He is describing things already that says he wants to take a closer look at what happens and maybe even let things play out a little bit more, and looking at productivity increases and things that might come from this. So I would be looking at this and saying, I'm hedging against making sure I'm confident nothing's going up in rates, and that I've probably got for a period of time while the economy stabilizes maybe a little bit. There's probably no cuts this year. I mean, I know, Tom, we have a bet on what was going to happen. I had stronger thoughts on what might be happening, certainly than I do right now with things, because we weren't predicting when we had those discussions in, I guess it would have been January, right, Tom, about we weren't anticipating that we would be 3 months at war and the Hormuz Strait being blocked and oil not getting through, and almost $7 oil here in California, or gas prices here in California. So I would be balancing this out from a standpoint that says, I want to make sure I'm hedging against the fact that I'm confident before I make some investments that rates aren't going to go up. They're probably going to stay fairly stable or a minor reduction for the next 8 to 12 months, probably in that place, and then make my business decisions based upon that.
Yeah, seems good. And compare it again with some of the prediction markets and so forth. But I agree.
I'm interested, Tom, as you described that. Let's talk about that for a moment before we go on. And I'm not suggesting it's right or wrong, or certainly not wrong. That's a bold statement, though, I think, that you make about a wholesale distributor using data points from a prediction market to make business decisions from. What are your thoughts on that, Mark? I'm not saying it's right or wrong. I just think it's really unique concept.
I think it's an evolution, as we mentioned, into the world where actually, whether it's our margin data, it's kind of the prediction markets. As businesses, we are almost overwhelmed with data points, which is where we're seeing the technologies like yours, and where AI can help us, where we can have many sets of eyes looking at things for us. And I'm always of the view, the more data, as long as you can use it and you can consume it, the better. And I think so. When you look at the quality of the data and you think, well, these prediction markets, they're live. They weren't written and 2 months ago sat on somebody's desk for approval, right. And it's not.
There's nothing lagging on it, right? Yeah. Everything else we look at is lagging data.
Yeah. So that's really useful. And I do think there's also this element of we think we've got everything nailed down, but then all of a sudden we have the situation with Iran and the price of oil, and suddenly you would say that the whole scenario's changed again. Mm-hmm. Which again is why the prediction markets are useful, because they can react hyper quick, as opposed to a report that was written yesterday. Something's announced by the administration today and it's out of date.
Well, and you can take multiple different predictions, right? So we were just talking about the prediction of a rate cut. That's all that was, and the betting occurs around that one. But there's other predictions about how long the war or the conflict will last, or will we have a agreement by a certain date, or there's a number of different prediction things that are, if you had a Venn diagram, they'd overlap, right? There is definitely overlap between them. So now if you took those together, right, and you had the feeds, or you had API feeds for those, maybe it's only half a dozen or 4 or 5, right? Not talking about 500. And you put those together, you now start to get a story that you could actually, as you point out, Mark, in real time, and it could adjust, right, as things go through on the predictability there. It's something, Kevin, I've been wanting to look into more. I don't know what they charge for API access, and things like that, but I think there's some really interesting, especially as they proliferate, right? You get more involved and more people and more participation. In theory, the better they should become, right? The more accurate they become. But they certainly have been proven to be even very accurate up to this point compared to other individual opinions or ideas. Yeah.
So what would you do with that API data? What were you thinking about that?
Well, if you wanted to incorporate into a trend, right? If you wanted to provide, again, into a system that says, what do you believe, interest rates are going, as an example, or what do we think this environment's going to look like, or whatever, right? Again, that just becomes more data that can be incorporated into your AI conversations or your AI agents, or decisions that are being made, or analysis that's being made as you go forward and trying to drive the business.
And Tom, I'm assuming with this as well, the beauty of this is, if something doesn't currently exist, you can make it exist. So if you wanted to know, for argument's sake, what do people predict crop yields are going to be on something, you can create this kind of thing and start to see, where people would be putting their money.
Yeah, it's a good question. I don't know. I'd have to go a little more research, but yeah, I don't know how new topics get started, right? Do you submit a topic and then they approve it and they think that that's relevant enough? But yes, you certainly can. You have the opportunity to potentially enter in new topics or new views of the things that can go together.
And I think it's such a strong piece you're mentioning, which is, if you just purely look at one index or market, you've only got what you get, obviously many perspectives, but on the same thing.
Yeah.
But when you start to overlay that as to your interest rates, maybe with the strength of the dollar, with other things, and you start to see an overriding pattern across them all,
right?
Your confidence grows that picture is correct.
Right. Because a lot of, and I'll just say one more thing, and then, in our technology, our software, right, we tend to look at a lot of historical data, right? We look at ERP, we look at purchasing trends, we look at things that have happened in the past, which you can use some of that data to help predict the future, right? But if you now combine that with what is believed in the predictability of where the future is going, you certainly have now a lot more potential intelligence, right? And what you're doing is here's what has happened, here's what we believe, or here's what the prediction markets or otherwise believe will happen. Now let's combine those together to use we talk a lot about forecasting, projections, all of those things now start to potentially become a lot more accurate and a lot more defendable because you have the data behind them of which to back it up.
And Tom, the other thing as well is you actually get to a point where the market is actually influenced because everybody's predicted it almost has to happen.
That's right.
Well, and I'm glad you said that, Mark, because what's been going through my mind, and it's really triggered for me when Tom first brought this up earlier in the show, was that, I'm thinking about, man, if I'm a CFO of a, $500 million distributor, or a finance manager, or a CEO of a $100 million distributor or similar size manufacturer, and you're suggesting I go look at Polymarket to help make these decisions. That could be like an 18-year-old Uber driver that, is influencing what Polymarket says. But if we have enough data and enough inputs to the data from enough different sources, then that is going to drive that, the likelihood of that actually happening. It's interesting because at that point in time, it doesn't really matter. Help me think through this. It doesn't really matter who the input is coming from, right? Because in theory, right, if I'm running a business, I want my data sources coming from relevant. I want it coming from a chartered, CPA or a chartered accountant. I want it coming from a data scientist, or I want it coming from an industry influencer who talks to people every day, all day about what's going on. I don't want it from somebody that's just wants to take a random bet on something on a Polymarket type or a Kalshi type system. So, but
remember, right, that these people are not, this isn't just a poll.
Yes.
Right? They're putting the money.
They're putting their money on it. Right. Yes.
Right.
Yeah. It becomes intriguing. Right.
Yeah.
Okay. So Mark, are you going to have some conversations with the executive leadership team at Enable and think about setting some trends and some plans based upon on prediction markets? Not yet.
Not yet. We're going to focus. We're going to stick with our rebates and our pricing. Stay where we know our subjects. But yeah, it's such an interesting area.
I'm going to wait for our Tuesday EOS leadership meeting with Tom and see if we've got financial decisions being made or suggestions being made off of those. But I think it's great. So let's shift gears a little bit. Let's talk briefly about, we have another article that we talked about today. It's from CFO Dive Magazine. Mark, and I'm interested, we're not going to spend a lot of time talking about tariffs, but we haven't really talked to you, and you're at industry events constantly and on the phone and in meetings with distribution, manufacturing experts and executives. So this article was talking about CFOs are facing a tricky tariff refund questions as processes are starting to gain speed. It says faster than expected results are easing early operational fears while shifting attention to decisions on accounting, tax, and financial reporting issues. So this is kind of starting to talk about, it's like, okay, we paid this out. Now we got this money coming back into our business. There's a balancing act that has to go with this. Any thoughts from either of you on that particular article?
Yeah, I mean, I've got some pretty strong views on this, which is when the tariffs first came around, those who invested in being able to deal with them did a lot better. That investment is now going to pay off again, because this money is not just going to be handed to you. My understanding is, you're going to have to do a lot of, you're still going to need to know what you're owed and make these claims back.
Sure. You got to prove you're owed. You have to prove that you're owed the money.
Yeah. So if you didn't have the right processes and procedures in place at the front, how are you now going to do it at the back?
Yep.
But then the other side is the follow-on from this. What are the customers going to say? Customers are going to say, hang on, you increased our prices. We agreed a very fair and transparent process. You said everything had to go up by 10%. I took it. I know you're getting your 10% back. I want it back, because that's how transparency works. What if you can't calculate that? What if you're going to upset your customers as well? So it's not just getting the money, being able to allocate it back, understanding the accounting requirements around these things as well. It's going to be really important, so the businesses don't get this wrong in terms of whether you're recognizing this as revenue and it's coming back to you. Is it cost of goods sold? Things like that. So this is really important, and it all assumes that nothing's going to change again. So I think it's there's a lot of question marks, and the circles that I'm in, it feels like the tariff noise has subsided. There's definitely this side of it, which is, this is all good news, but how are we going to deal with it?
Well, you're bringing up something that, we've talked about a lot here is, the downstream effect of it, right? Because we've got the importer of record, which typically is going to be the manufacturer, unless the distributor is doing private label work on their own and so forth. But in general, that's what we're going to see. And Mark, with you being an accountant, you could probably comment on this well, is that, one of the comments that I made very early on, you might have heard it in the show, and Tom and I have discussed, is that a big component about how this plays out, because you're talking about the downstream impact. So if manufacturer gets this tariff money back, distributor starts thinking, well, wait a minute, XYZ manufacturer that I've spent all this money with, you got this money back, I want some of it back. And then the downstream risk of that is that the contractor that bought the water heater that had a tariff associated with it from the distributor got followed up on. And then as the three of us as homeowners, we call the contractor and he just raised his price. What happens, right? There's a very unique evolution or ecosystem there that happens. Now, we've said over and over again and probably accepted the fact that it's unlikely that downstream contractor down to, consumer are going to see any value from that, right? I joke about it all the time with Tom, is that, Costco's filed this $200 million lawsuit. Well, I can't get to the interstate without driving by Costco. Are they going to apply something back to my account because of all those extra fees I paid in tariffs? Obviously, it's unlikely. But where I think it is important, and Mark, I'll throw this to you just because of your experience as in the accounting field, is I think a huge component of what you described, my friend, as that distributor that wants to potentially go back to the manufacturer is, what was the wording on the line item on an invoice from a manufacturer of how did they describe that increase? Is it a straight line that just says tariff adjustment? Is it a line that says something else, or is it just an increase? Because I think that's really going to play out, is how did they describe it? So any thoughts on that from your background and experience?
Yeah, I think completely agree. There was a lot of recommendations at the time about using things like surcharge mechanisms and things like that, which you would argue if the money comes back, it should be passed back. And I also, it's a really kind of interesting topic. How far back down the chain should the money go? And ultimately, so then if it stops somewhere, does that party end up with the big benefit? Manufacturer doesn't, they pass it off to the distributor passes it off to the contractor suddenly doesn't pass it to the consumer. So all the contractors are, sitting pretty. I can't see that happening. So it's going to be interesting how it really plays out. The other concern for me with anything like this, and I said this right at the beginning of tariffs, is, I mentioned it earlier, for distributors, inflation, we buy the goods today, we sell them in 60 days' time. Generally, we're selling them, that it's good when prices are going up. If this was to create price decreases, that could actually be a real challenge, because we're buying the goods today and then selling them for less in 60 days' time. So that's something that distributors always have to be ultra mindful of as well. So, and we've got these new price points and these price perceptions. So could this just end up being, some people in the supply chain are just going to continue being a little bit more profitable thanks to these tariffs. So lots of great questions, and all I would say, I would just caution businesses on how you account for these things, because there's going to be some
legally it's taxable income. So any refund that they get is potentially a form of income, right? That could be taxable on their piece. So that's come across loud and clear.
So it's good news, but it's also more work.
Yeah. Well, and to your point earlier, right? It's how did you handle this early on is a big from a manufacturing standpoint. Is how did you handle this early on is critical. And I guess for a distributor, the same thing, right? Is how did they manage that process? If you managed it well, you got some early gains as you described, and we had some good conversations just as this was getting started, is that there are some opportunities for people that had really strong balance sheets that could manage balancing inventories of last in, first out, so forth, and really figuring out how our inventory and overall costs are balanced based upon all of this. But that's leveraging strong balance sheets helps anytime. But I think it's how you manage this in the back end. But now moving forward, and what I wonder about is, are people going to start looking at it as saying, okay, let's just say I got $500,000 back if I'm a small mid-sized manufacturer. Should I be setting some of that aside in case I have somebody wanting to sue me, or I have a group of people that are wanting to come after me? Should I be thinking about setting some of those dollars aside as well? And now I've got taxable income, to Tom's point, that I could potentially have people coming back and putting pressure on me to share with them. How do I manage this? What do I do?
I think here's what I would do if it were me in my shoes. I think there's an opportunity here, whether you're the manufacturer or other system of record, from a PR and a brand development perspective, to just basically send a letter or a note to your distributors and your other people and go, either A, I'm not beginning any of these refunds for whatever reason. We will not be receiving these refunds, whatever. But if we are, right, here is our plan, right? And our plan is, it may not be a rebate, or it maybe is a rebate, or maybe it's money back, or maybe, I don't know. I mean, there's a million different ways you can handle it. But I think by being transparent and by being upfront with it, rather than trying to hide it and hope that people don't catch it, I think you have a real opportunity to continue to develop the relationships that you have with your distributors and downstream partners, and build some brand loyalty or brand recognition from doing it. I think Costco could do something really simple, Kevin. They could say, we have filed suit for blah, blah, blah. If we receive $200 million, our plan is
Kevin and Darlene get it all.
Right. When you get your annual check or whatever for the money you spend, you'll see an extra percentage there. We appreciate your ongoing support, and we're working to share the wealth. It's very simple, right? It just alleviates it. It's when you say nothing, or somebody feels like you're trying to cheat them, or you're trying to do, that's where the lawsuits come. That's where all the other things start to, come into play. So I think there's an opportunity here.
The idea of people feeling like you're profiting from me.
That's right.
Right. Good.
To your point, Tom, it could just be a matter of data. Costco may know exactly it's 20 extra cents on this product, 15 on that, and they've got full purchase records of every customer.
That's right.
And just run a calculation and give everybody back. I also do wonder whether there would be any pressure from the government to say, hang on, we're trying to get prices down as per the president's commitment. You need to get this money needs to get back. And we want to see that in price reductions, because some of the Costco's and some of the other large corporations put a lot of pressure on the government when the tariffs first came out. The government will now flip it and say, okay, you got what you wanted, now give it back.
Yep.
Well, we could spend the next hour on this topic, but I'm going to make a statement. You guys can choose to respond, or we can move on from here. But I think the bigger factor that we haven't mentioned anything about here yet is the fact that it almost sounds like, from our discussion in this topic, that tariffs are done and behind us, right? Tariffs just have a different statute that they're coming with now. And then, Mark, we talked last week about the European Union has now fully voted and ratified, right, their tariff agreement with the U.S. So it doesn't even matter what statute it's coming from. And, Tom and I were discussing that there's likely a whole lot more people that are probably going to follow suit that says, Uncle, we give, white flag, you're going to get some type of tariff through. Let's negotiate with you and get the best deal we think we can, and just agree to that. And then the tariff thing goes away from that line item of a tariff per se, because we just have a new trade deal.
Yeah, and I was expecting, maybe falsely, on the back of President Trump's visit to China, tariffs, we know they were discussed, but we haven't seen any announcements in that space. So
I thought about that a lot, my friend, and what I came up with related to that was that there's so much going on with the war and the impact of the war and fuel prices, and then the fact that China needs so much fuel, that I'm guessing that the figuring out what's going on with the war probably overshadowed a lot of those conversations.
Yeah,
I think it just would have had to. I think if we didn't have the Hormuz Strait blocked, then that probably would have been a much, much, much stronger level of discussion, and much more would have come out of it about that. So it's just interesting. What will be, I just thought about something, and I don't want to give credit where credits may not be due, but how crazy would it be if, when all this is said and done, and we look back 10 years from now about this whole tariff thing that we've, it's been wonderful fodder for this show, but if we look back at it and realize that now there's these, Latin American, Canadian, European Union, Chinese, Southeast Asia, Indian trade deals that are now in place, that all came out of it because of this tariff threat. That was this big uproar that went to the Supreme Court, that some old guy with orange hair, this was his plan all along. I'm going to create this international uproar. People are going to hate me. And when all's said and done, I'm going to have trade deals that don't even need tariffs that are really good for the U.S. It's that three-dimensional chess. Is that what they call it? Long game. Who knows? Who knows what'll come from. So, hey, before we jump in, there's a big breaking news this week that we want to talk about in manufacturing distribution, but there is an article that we had that's quoted here, and it talks about and it's from, I just want to double check where it's from supply and demand chain executive.com. And it talks about the 6 maritime choke points of global trade. And Tom, the reason I wanted to just hit on that for a minute is, over the last few years of this show, we've had Suez Canal issues. We've had South China Sea issues that we've talked about, and certainly Panama Canal issues. And now we've been talking consistently about the Strait of Hormuz. And this talks about the reality of what can really happen when it talks about efficiency versus fragility of just-in-time inventory versus just-in-case inventory that comes when we have these shock waves that hit us from these things. And it talked about, there was a particular piece that talked about in 2021 when the Suez Canal was blocked, the cost of it was $9.6 billion per day. And so these choke points that it references are the Strait of Hormuz, which we're dealing with now, right, in the Middle East, the Suez Canal, which connects Europe and Asia through there, the South China Sea, which then talks about is key access points to the Strait of Malacca and moving through there, the Panama Canal that links the Atlantic and the Pacific, the English Channel, kind of surprised me, but maybe that's my inefficiency in geography of recognizing that linking the North Sea to the Atlantic, but it does make sense if I stop and think about that, right? We've got everything from Northern Europe that needs to go through the English Channel there, and then the Bosphorus Strait as well. So I just thought it was, I typically would think about, Suez Canal, Panama Canal, mostly in this setting. But anyways, any takeaways from you guys on that?
No, I mean, those are the six choke points, right? And we've had three of them, or 3 or 4 of them that have had impact on thing. And I guess it ties back into this final article in the section here about supply chain's new normal isn't stability, it's change.
Right. Yep. And we don't, and I think that's important. And we don't think about, what really goes through, this. And, there's single container ships can hold 20,000 containers. So when we stop and really think about what is going on in shipping, it's just the magnitude is it's astounding. And, it talks about, this article reference that there's 12,758 vessels through the Suez Canal, just the Suez Canal in 2025. So, crazy statistics of what's going on and what's actually moving out there. And when we talk about the Strait of Hormuz, it's interesting. We were talking about gas prices. My wife and I were last weekend, and, I was commenting about fertilizer and all of the other commodities that, we don't think about. Helium, right? That's the vast majority of that's coming out for the world is coming out of the Middle East and through the Strait of Hormuz. So, the volatility that goes with these choke points is great. So we can jump ahead. I just wanted to make that reference. It's a great chart that's there. Check out today's newsletter, and you can see that and read the whole article there. So jumping into manufacturing and supply chain, big announcement this week, which was a lot of so many of our listeners are in the industrial, the building material world, electrical, plumbing, HVAC, and so forth, and so many of the distributors that make up the network and our ecosystem and family here within the Around the Horn and Wholesale Distribution show are part of buying groups and trade groups. And one of the large, or I won't say large, but good size and long-lived and well-known buying groups within the industrial and construction segment, Evergreen, shut their doors basically this week. And it's a big deal. It impacts 37 years of operations. And it was kind of surprising because last year they had just shown that their member sales were up 13%. And I had heard quite a few rumors going on for the last few months within the industry that there was quite a bit of discussion about them being bought and or some mergers with some others. But they ended up just shutting down. So it was kind of surprising to see.
So what's the impact? What is the impact, and why would they just shut down?
Well, they obviously they weren't achieving enough. So the challenge is there are very large buying groups, and a good example is affiliated distributors. They pass on 100% of their rebates, right? Mark, you know a little bit about this. Since Mark's company manages the rebates for them, is that 100% of the rebates go back to the members. So there's pressure on the smaller buying groups because they can't do that because they don't have the dollar volume going through them. And the smaller buying groups typically are getting their cash as a percentage back from the manufacturer versus the distributor paying their bills for those particular vendors through the buying group. And then the buying group can live off the float of those dollars. But if you're waiting on those dollars coming back from a manufacturer, you're sharing those dollars now back with your members. Your members don't maximize the rebates that they could be getting because they're sharing the dollars, right? There's a gap in that. And I don't know the financial situation of what was going on with Evergreen. My assumption was they couldn't continue to make it work. But what I've been seeing with other mid-sized buying groups out there, that some of the struggle is because of just the business model and the sheer volume of revenue, is that you have the larger, and this could be within any, well, it doesn't matter whether it's an organization like affiliated distributors and Evergreen to impact, or a buying group in the medical marketplace or the office products or food service or wherever it is, same economics. Is if you can't pass on 100% of your rebate dollars, and you've got members who are continuing to grow their business in spite of that, eventually they become attractive to the buying group that can pass on 100% of their rebates or just even a higher percentage, and you tend to then start losing members to the behemoth.
It's a churn issue.
Exactly right. And there's a point in time where it's not sustainable anymore. And I think that's what we saw this week.
Because you're not adding enough new members to offset the churn.
Not enough new companies starting, right?
Right.
When you think about, Tom, if you think about our customers at LeadSmart, we have, multiple companies and customers that are 100 plus years old.
Sure.
So, right, you start thinking about that. It's not like there's 10 new, and while I'm sure you could look at the statistics, and there are a lot of new wholesale distributors starting every year. They're not driving huge revenue amounts that impact.
Volumes are not right enough.
Exactly right. Yeah, exactly right. So, I think it's extremely valuable to have a lot of players in them, not necessarily a lot, but multiple players in each vertical in the buying group arena. But it's fragile. Mark, any thoughts on it?
Yeah, there's definitely the risk of further consolidation, I think, in this space. Because just as the manufacturers are competing and the distributors are competing, these buying groups and co-ops are also competing.
Yep.
And if, we're fortunate to have a few clients in that space. And when you speak to them, they say, in many cases, they can have 10, 15-year long relationships, even longer, who are coming to them saying, but this one will give me a 5% rebate when you only give me 4%. And that's the top and bottom of the conversation. Yeah. And what happens, like you said, is then to the manufacturer who's funding this, do they put their money where the buying group that's growing members, growing spend, who will insist on better terms than the competitors? So it happens the same in business. The big businesses eat the small businesses, the big buying groups, I think we'll see them increasingly eat the small ones.
Yeah. Well, I think in this particular case, I know there were some discussions from another buying group. I won't mention them, but about them acquiring Evergreen, or even there being some level of a merger. And my assumption has to be that it was too little too late in this particular case.
The numbers didn't play out, right? The numbers didn't pencil out.
Yeah.
And so,
but in this case, there's already been announcements by the Sphere One buying group that a large number of Evergreen members have come over to them, and I know that Affiliated Distributors has already picked up a handful of the ones that were already attractive to them to start with. But I was at an event a couple of years ago of a buying group, and was playing in their golf outing, and I was talking with a senior executive of a major industrial supply company, and we were playing together in a foursome and chatting quite a bit, and he was actually their company was actually a member of 2 buying groups, and it just because they do construction and industrial, and there was crossover, and he was trying to figure out what to do with that. But then he was also being courted by one of the biggest ones at the same time, and he said it's just the challenge is, he said, we have just deep personal relationships within these groups as well, and so there's more than just the economics. There's the personal and human component of it, that he was really struggling with. But they ended up moving from one to, I think in the end, they were still part of Evergreen and then also Affiliated Distributors at that point. So they just roll everything over to AD at that point. But, good news for some of the larger buying groups. But anyway, sad to see this go away. So
what I would add as well is what I've seen the really good buying groups do. It's not just about buying. They help their members sell as well.
Sure.
And that's where I'm seeing the differentiator these days. And I was at a conference last year, and there was a real big focus around that and creating this community. Never good to see things closing down, but I suppose it is business.
It's the world we live in. No matter how we slice that. Let's slide into our AI and segment. Is that all right, Tom?
Yeah. Before I do that, I want to do a quick shout out to my friend Niall, who just made a comment in the comment. I haven't talked to Niall in a few years, but he is the ultimate visionary person of all time. He was one of the creators of MTV. Wow. Really, really an amazing visionary. So Niall, great to see you here, and thanks for checking in.
That's really cool.
Been a long time, yes.
I want my MTV. Remember that?
You're dating yourself. You're dating yourself.
Dire Straits, right?
I don't think
that was you guys.
Yeah, that was Dire Straits. Yes.
Come on.
Yes. Do you know what the first song was that was played on MTV?
Oh, I probably won't get it. Go ahead.
No, I don't think I know. I think it was Niall maybe can tell us, but I think it was a Michael Jackson song or a Madonna song, but I'm not 100% sure.
All right.
Where are we going now?
It was the first song ever played on. This is crazy. So what did you say, Tom? Madonna or Michael Jackson?
Michael Jackson, yeah.
How about the Buggles?
The what?
Video killed the radio star. Remember that song?
I do, but who sang that?
The Buggles.
How do you spell that?
Buggles.
It's not the Bengals, the Buggles.
The Buggles.
Wow.
Video Killed the Radio Star was the first song ever played on MTV. It is astounding the things that we can find on Gemini in just a flash of a moment, huh?
Okay.
So, all right. So Mark's thinking, why did I join these guys today? They, one of them's trying to sing and they're talking about stuff.
Don't give up your day job. So
yeah.
I was thinking actually my favorite MTV program used to be MTV Cribs. See how the rich and wealthy live. And that was always interesting.
That was later though. In the beginning, all it was just was videos, right?
That's all they played is videos. Yeah. But now we're 1981, right? So is August 1st, 1981 at 12:01 a.m. was the first one that aired. So it just, all that shows is there's a generational gap between Mark and Tom and I, because Tom and I were juniors in high school in 1981. Yeah. We were just getting ready to go into our senior year of high school.
Well, so, and MTV, along with ESPN and all those, only really came about through the proliferation of cable TV, right? Which really did
absolutely
up until that point.
Because Mark, here's where the era Tom and I grew up in. Our whole entire life, we've had remote control TVs, because for the first 15, 16 years of our life, our dads would tell us what channel to go change.
Yeah, go get up and turn channel 4.
We would get up and go walk over to the TV because we were our father's remote until the real ones came along. So,
but these the same TVs where you would go around the back and there was a little knob and it would make the picture stop rolling. Or whatever.
Yeah. Well, and then you'd have to adjust. Did we put foil on the antennas or not? So I'm confident nobody came here for that today. So
all right. So now that we're done with our historical TV section, where are we going next?
But Niall, thanks for joining us. It's great to have you with us, and we just a complete rabbit hole in the show. I think we should jump into our AI technology section. There's an article there from IT Pro. NVIDIA CEO Jensen Huang says that these professions will be the big winners of the generative AI boom. But the reason that I wanted to talk about this is I think it's a good stepping off point. First, let's talk about the article a little bit. And we've got so much of a discussion about data centers and being built and so forth. But it's a stepping off point into a topic, Mark, that you had brought up that we should talk a little bit about today, about some of how manufacturers are starting to view data. And I think it'll be a good jumping off point. But let's talk about this a little bit at first. So you guys get a look at that article?
Yeah. I mean, basically what he has said, which people probably wouldn't immediately think, is the winners right now are the tradesmen, right? So the electrician, the builder, all of this infrastructure.
Iron workers, plumbers, electricians, HVAC techs. Right.
All of this infrastructure that we need to be building requires, we don't have robots doing it yet. So it requires people skilled. And you think about just like these data centers, right? These aren't just an ordinary project, right? There's so much involved in them and so much, the cooling and everything else involved in all of that. So, yeah, I know. I mean, I know there's, definitely, I know of plumbers and electricians and so forth that are making $250, $300 an hour right now. And his point being is, this is kind of a opportunity to, and I was talking to somebody that, he was telling their kids, right, that, if you're going to don't go study computer science in school, go study electric or electrical or learn how to be an electrician or a plumber or things like that if you really want to make big money and not be at risk of being replaced right away by AI.
Our youngest son, right, Austin, Tom is he's a couple of years out of school, is married, he's got a little baby now, and he's got a pretty good job, but he's interested in getting involved in law enforcement, which is a noble career, and I admire that. But I've been talking to him about trades, and it's safe. You're home every night with your family. Nobody's asking you to. Well, rarely are you going to need to work in the middle of the night, and you could probably make double the salary as and where they live in Colorado Springs, in Colorado. There's just booming building going on there, and it's like he's I'm just a data source and a data point for him at this stage. He's going to do what he wants to do, but I've been encouraging that. So anyways, let's kind of continue. Mark, you had brought up an interesting point though, that you had we were text messaging yesterday about some conversation while we're talking about AI and technology. I think rather than kind of jumping to all of these next articles, although there's a couple of additional good ones, one from McKinsey about AI assembly lines and strategic imperatives for CEOs to be thinking about. We can talk about that a little bit. But Mark, can you kind of introduce that discussion and comment that you had made about some discussions you've been having with some manufacturers recently?
Yeah, absolutely. And it makes sense when you think about it, but it's something you don't immediately think of. So I've been speaking to a number of manufacturers recently, and they're a bit nervous about how distributors are going about implementing AI, because these manufacturers have spent decades building relationships with these distributors, and there's the risk that all of a sudden future decisions are not going to be made based on a relationship. They're going to be made based on what the AI model based on data tells that distributor, which might be stop selling that manufacturer's products and sell this one's instead. Mm-hmm. Which means that the value of that relationship, AI doesn't look at that. It doesn't look at, did you give me tickets to the Yankees game or anything like that. It purely looks at the data. Mm-hmm. And so the manufacturers that I've been speaking to are saying, how can we safeguard against this risk? We're mindful that the way we do business with our distributors is going to change because of AI. Mm-hmm. And it really got me to thinking about, how much is that landscape going to change? And it might be that there's still a relationship, but the relationship is going to have data at its foundation. Mm-hmm. And so I thought it was a really interesting point. And as I've discussed it with multiple manufacturers, it is a concern they're having. So
Mark, do you think that this impacts both sides of the equation, the manufacturer and the distributor? Because it's not just the manufacturer that's building the ties based on relationships. The distributor is doing the same thing as well.
Yeah, I mean, it does work both ways. I just feel that the manufacturers, especially in certain industries, for a long time, have enjoyed, certainly on certain product ranges, very healthy margins, and have been able to exert a degree of dominance. Whereas what we're going to see is just purely data-driven decisions. And so when you think about it, and I'm just making things up here, but you might have products that are 10% cheaper, but with 99% of the quality. And the AI will look at that and go, well, actually, I've done all the maths, I've done the trade-off. We're not going to go with the branded manufacturer anymore.
Yep.
And so
that, Mark, I'm sorry to interrupt you there, but that implies to make the right decision that you have a lot more data points than just ERP data, because there's a lot of, I'll just say, intrinsic things, the brand recognition and some different things like that. And I think you're already alluding to that a little bit, but you need a whole lot more data, I would say, to really make a decision than just straight ERP data. It's probably the core and the most important part, but you need more than just that. Wouldn't you agree?
Yeah, absolutely. And I think where this gets to as well is, again, we've traded for so long on instinct. We assume our customer is brand loyal. Mm-hmm. And maybe it's never been tested. Well, AI will come along and test these things and say, hang on, no, yes, the customer's loyal to this particular product, but this one, they'll take just the cheapest item on the shelf. Mm-hmm. So, a lot of these assumptions are going to be challenged.
Do you think that this will cause manufacturers to be more willing or to take that step to go direct and do more with, even the Amazons and things like that? Do you think that it opens up that door more or encourages that more?
I'm not sure. What I am certain of is it's going to mean that manufacturers are going to have to do a whole lot more in terms of helping distributors become sales houses rather than order takers. They're going to have to really invest in that space, so that decisions can be educated. Almost the manufacturer is going to have to help guide the distributor's AI and things, but also the manufacturer is going to learn as well.
I think that's you just kind of nailed it, right? The manufacturer in this case, and I think from what we were texting about yesterday, is they probably don't want to do this or maybe don't even know how, is they need to be having more data, more understanding to help the distributor understand their value. Right. And historically, that's been limited to things like quality, inventory levels, brand recognition, and things that they can, control. And the brand side of it kind of comes from that, baseball tickets and hockey games and barbecues and the things that go with that. I think that will always play a component, right? And then we just spent all that time a little bit ago talking about buying groups and so forth. The buying group probably is going to need to be able to have some level of an understanding, or maybe being able to help a manufacturer with some maybe aggregated data that would help them make some decisions to support and develop their distributors and distribution a little bit more. I think it's interesting. I started my career in the early 90s, working for a distributor, carrying a bag and so forth, and selling the old-fashioned way. We sold on value and relationships and pulling through things that, when I worked as a manufacturer's rep, pulling things through, the end user and helping the end user understand the brand value. Now we're just needing to do that exponentially better, right? Because there's always going to be that human component. And I think there's going to be some of that relationship piece that if all things were equal, Mark, to the analysis you just described, if things were, let's just say, within 3 to 5 percentage points, you could have the human relationship component push something over the top. But when you start seeing these trend lines that say, well, it's 5%, but it's 5% on this category and 3% on this next category from the same vendor and 7% in this other category that we buy from, wow, it becomes powerful. Yeah. I'd suggest, this just came to my mind, but I'd suggest for the manufacturer is if you could get ahead of that for your distributor to help them see why they should be buying more from you. Tom, it's literally what we're doing for distributors with LeadSmart, with our revenue expander tool that identifies white space and helps the distributor see where an end user should be buying more from them that they're not buying. If a manufacturer could get their head around using AI and other tools that says, going back to the distributor that says, here's the economic pressures we understand you're under. Here's what we understand is going on with your customers as well. And here's how we think we can help you solve that problem in our partnership. They'll win. But if they don't have that data, it could be a struggle.
So just to wrap up here, Bob made a comment. He said buyers want the risk minimized and more data doesn't get them closer to that. Mark, what's your thought on that? Do you agree, or the data is not?
Yeah, really I think, like I said earlier, there's no shortage of data out there. I think in terms of what we're looking at here is the data is great, but I think the most important thing is, what are you asking the AI to do? If the AI doesn't have the right brief or isn't configured the right way, it's very much a kind of point it in a direction and pull the trigger. So do you tell the AI that you are trying to improve the profitability of the supply chain or just your business? And things like that, and understanding how that's working.
But you can even ask the AI to help improve the relationship, right? What do I do to solidify the relationship too? The EQ. It
all depends on the brief the AI has, not the amount of data it has, in my opinion.
That's a good point.
And I just think, I see it in data. where I can see a manufacturer making 60% and the distributor making 20. And then on the flip side, I see a distributor making 40 and a manufacturer, say, making 40.
Yeah.
AI is going to come along, and I assume it's going to try and normalize some of this.
Sure.
The worst thing that can happen is it comes along and starts trying to reduce prices in marketplaces.
Yeah.
Because that doesn't help anybody.
Yeah, but that's likely the next use case that flows from this discussion, right?
Yeah.
Right. And but what's interesting about that, I'll tie this in, is we referenced affiliated distributors earlier, our good friends there, and I do all of their divisional events each year where they've got their national meetings and they've got their members that are coming to meet with the manufacturers and some of the service providers like our company. It's astounding the amount of, this is not just at AD, AD has some of the most forward-thinking and advanced members out there. This across the board in wholesale distribution, specifically in North America, is the amount of, I'll say $100 to $1 billion a year companies that are still going to meetings with their manufacturers with 3-ring binders and spreadsheet printouts and ERP printouts and a binder. Astounding to see that in 2026. Now, maybe I'll get to those events this fall and I'll see none of that. I don't think so, right? So there are going to be those people, though, that are taking that data and instead of printing it out in a 3D binder, they're running it into, say, AI models that are going to really help them when they sit down with an event. And I think, Mark, you brought, in bringing this whole topic up, this is the angst of a manufacturer, is when a distributor can come back to them with just tons and tons of data that they've never had before, but they can aggregate it so much better now to make decisions and come back and start asking for concessions or different things that will be very uncomfortable.
Interesting point. All right, Kevin, we need to wrap up.
You got to go somewhere to be?
I got somewhere to be. Yeah.
Okay. Down the hall.
Meetings to go to, things to do.
That's right. And it's Friday. Mark, any big plans for the weekend?
My father's over. So
fantastic.
First time ever in the United States. So been taking him to all the kind of the local places and things like that. So yeah. Take him to the local Lowe's, everything like that. He's getting to see the full experience.
What does he think about?
Here to get him to Waffle House so he can get that experience.
That's it.
I was going to say, what does he think about North Carolina barbecue so far?
He likes it. Yeah, he really does. We've had the grill on just about every single night. So
okay,
yeah.
Well, tell him that I'm a big fan of his son, and he did well. In raising you with some smart. So, Mark, we thank you for being with us. You're always a great guest. We're certainly appreciative of you, and everybody that joined us today, and the comments that came in were great. We're appreciative of that, and we've had quite a few new listeners. Last week, I think the show got out on the recorded podcast format. I think we were in either 7 or 8 countries we had downloads and listeners in. So we're appreciative of the growth of the show and the support that we have behind the scenes with Lily and John and their teams getting us ready to do these each week. So again, we love it when you're with us, and we appreciate the folks that comment on a regular basis. If you'd like to help us grow and continue to expand the audience that we have, hit the subscribe button, share the newsletter with your friends. Again, if you don't get that newsletter, we'd love to get it out to you. Simply just request it at hello@leadsmarttech.com or search us out on LinkedIn and find it there, and we'll get that out to you as well. And we appreciate everybody helping us and the support of that. Lastly, again, we couldn't do this every week without the support of the company that Tom and I work for, LeadSmart Technology. So if your company is looking to digitally transform, understand your customers better, find risks, rewards, opportunities to accelerate growth within your business, and understand your team, your customer, and your overall business better, we'd love to chat with you about our enterprise growth platform and see how that can help you like it helps lots of other companies. So, Mark, thanks again. Tom, we'll catch you on the next meeting that's coming up not too long, and we appreciate you all, and we'll wish you a great weekend.
Thanks, everyone.
Thanks.
We hope you enjoyed today's episode and our guests. Each week, we try our best to dig into the topics that are impacting your business. So please reach out to us and let us know how you think we can make the show better, or topics you'd like for us to tackle or talk about more often, and even guests you'd like to see join us. We're looking forward to bringing you next week's session and hope that until then, you stay safe, stay focused, and do great things. If you haven't already, please subscribe to the podcast and leave a review to help others in wholesale distribution get access to the conversation. And finally, please check out our sponsor, LeadSmart Technologies, and their manufacturing and wholesale distribution industry CRM, customer intelligence, and channel collaboration platform. That's LeadSmart Technologies at leadsmarttech.com.